Hey there, welcome to this deep dive.
Oh, into Vedanta Ltd's Q2 FY25 results, right?
You got it. You all wanted to get a clearer picture of how they've been performing lately.
And we're here to help with that.
Exactly. We've got a bunch of sources to work with here. We've got the official press release,
The investor presentation.
and even a peek at the auditor's review.
Sneak peek, like we're financial detectives.
Yeah, I like that, like financial detectives.
Piecing together the clues to understand, not just numbers themselves, but
Yeah, exactly.
the story,
Just story behind them.
what's driving this performance, and then, the big question. What does this all mean for the future?
Yeah, absolutely. Okay, so Vedanta had a stellar quarter. Actually, it was a record-breaking first half of the fiscal year for them. They hit their highest ever EBITDA, and maybe for those who haven't encountered that term before, it stands for earnings before interest, taxes, depreciation, and amortization. Think of it as like the raw profit a company makes from its core operations.
Like,
The core, yeah.
yeah, and for Vedanta, this number hit a whopping 20,639 crore, a 46% jump year over year. What's even more impressive is this is two consecutive quarters where they've crossed the 10,000 crore EBITDA mark.
That's right. Back to back.
Back to back.
It's not a fluke.
It's not a fluke. And their profit after tax, before we factor in any exceptional items, is also remarkable, 4,467 crore. That's a staggering 230% increase year over year. Plus, they've got a robust free cash flow pre-capex of 8,525 crore, up 50% year over year. These are some serious gains.
They are. And those numbers, they kind of jump off the page.
Yeah. So it sounds like they're firing on all cylinders, but what's the secret sauce behind all of this success?
Well, it's multifaceted. Certainly favorable commodity prices played a role.
Yeah, I was thinking that. Think about it. Zinc, aluminum, oil and gas, all of these are seeing price increases, which naturally benefits a company like Vedanta.
Mhm.
But what's interesting is Vedanta isn't just riding the wave of higher prices. They're actively boosting their production volumes too.
That's right.
They hit record production levels in key areas like aluminum, zinc India, and iron ore, which tells you they're becoming more efficient at squeezing output
Right.
from their existing assets.
So they're not just getting lucky with market prices, they're making things happen.
Exactly.
Now, this is where it gets really intriguing for me. Their investor presentation highlights some strategic initiatives they've implemented, like cost reduction measures and efficiency improvements.
Yes, streamlining things.
Streamlining. And it seems like these moves are adding, fuel to the fire, further boosting their profitability. So it's like a perfect storm brewing in their favor, wouldn't you say?
It is. It's a mix of both some smart internal strategies coupled with a favorable external environment, those two working in tandem.
Yeah.
Now, let's zoom in a little bit. Let's look at some of their different business segments to understand what's happening on the ground.
I like it.
Starting with aluminum, one of their core businesses. Vedanta achieved an all-time high in their first half cast metal production,
Okay.
reaching 12,205 kilotons, a 3% increase year over year. They even hit the highest ever quarterly production at 609 kilotons. And here's what's really noteworthy for you. They managed to achieve this while simultaneously decreasing their production costs.
So it's a win-win, right? Lower production costs for Vedanta and potentially lower prices down the line for consumers like you and me.
Yeah, ideally. And it's great to see a company making strides in efficiency.
Now, what about Zinc India? What's the story there?
Well, Zinc India is another star performer. They've hit record highs in both quarterly mined and refined metal production.
Okay.
And what's really interesting is their growing dominance in the Indian market.
Yeah.
Their domestic market share jumped from 71% to 78% year over year.
Wow, they're really solidifying their position as like the leading zinc producer in India.
They are.
And they're not just focused on producing more zinc, they're also making moves that could impact like the future of energy.
Absolutely. They're significantly ramping up their investment in renewable energy, aiming to increase their usage from 50% to 70%.
Wow.
And here's a fun fact that might pique your interest. They're also partnering to develop zinc-based batteries. Think of it as a potential game changer in the world of energy storage.
Zinc-based batteries, huh? That's something I'll definitely be keeping my eye on. It seems like Vedanta is thinking long-term and strategically positioning themselves for the future. Now, what about their international zinc operations? How's Zinc International performing?
Well, Zinc International is showcasing impressive performance, particularly their Gamsberg operation in South Africa. They've achieved record low production costs there, which is a big win for their bottom line. Additionally, their magnetite project is progressing well and is on track for completion in the fourth quarter of FY25.
So steady growth and a focus on efficiency. It's a consistent theme across their zinc operations.
Yeah.
Now, before we move on to their other segments, let's take a quick financial health check. I think it's important to kind of like understand their overall financial stability before we go deeper into the specifics.
Makes sense.
What do their debt levels look like?
Sure. Let's take a look. Their gross debt stands at 78,654 crore, and their net debt comes in at 56,927 crore.
Okay, now those are big numbers, I know, but what's important is to look at them in context. Their net debt to EBITDA ratio is actually improving.
It is.
It's currently at 1.49x, marking the best position in the last 6 quarters.
That's a trend in the right direction.
Yeah. But what about their liquidity? Do they have enough cash on hand to keep things running smoothly?
Yeah, they seem to be in good shape there as well. Their cash and cash equivalents are healthy, sitting at 21,727 crore, a 30% increase both year over year and quarter over quarter.
Wow, and to top it off, they've received some positive news from credit rating agencies.
Yeah, a little bit of vote of confidence.
Yeah, what did the agencies have to say?
Well, ICRA upgraded their long-term rating from AA to AA, and Crystal revised their outlook to wash with positive implications, which essentially means they're optimistic about Vedanta's future prospects.
So it sounds like Vedanta is getting a thumbs up from the financial markets, which is reassuring. Now, I know we have a few more segments to cover, like iron and steel, copper, and power. But before we get to those, I'm curious about their commitment to ESG, environmental, social, and governance factors. It's something that's like top of mind for many investors these days.
For sure.
Are they walking the talk when it comes to sustainability?
Absolutely. They're taking ESG seriously and making some noteworthy strides. For instance, they've signed agreements for a whopping 1,906 megawatts of renewable energy.
That's amazing.
Yeah. They're utilizing this renewable energy in their zinc, India, and aluminum operations,
Yep.
which aligns with their goal of reducing their carbon footprint.
So that's a significant commitment to renewable energy. Anything else standing out in their ESG initiatives?
Yeah, they've also exceeded their gender diversity goals, achieving 22% women employees, surpassing their 20% target for fiscal year 2030. That means they've reached this target 7 years ahead of schedule.
Wow. And they received a high ranking in the S&P Global Corporate Sustainability Assessment. It seems like they're not just talking about sustainability, but actually putting in the effort to make it a core part of their operations.
They are. Now, with all this positive momentum, what's next for Vedanta? What does the future hold?
Yeah.
Well, they have a lot of exciting growth projects in the pipeline. We can expect the commissioning of significant expansion projects in the coming quarters, like their Lanjigar refinery. This should further boost their production capacity and contribute to continued growth and profitability.
So continued growth and profitability on the horizon.
Yeah.
Is there anything else we should be watching out for?
Yes. One more key development to keep an eye on their demerger is in the final stages. This is a significant restructuring that will split the company into 6 separate listed entities. It's a bold move, and it'll be interesting to see how it plays out. But we'll get into more details about the demerger a bit later.
Okay, we've covered a lot of ground in this first part of our deep dive. We've seen that Vedanta is on a roll, demonstrating strong financial and operational performance. But let's not forget, we're just getting started.
It's just getting warmed up.
Yeah, in the next part, we'll roll up our sleeves and dive deeper into the specifics of their financials. Stay tuned.
I'm looking forward to unpacking those numbers and gaining even deeper insights into Vedanta's impressive performance.
All right, let's do it.
Shift gears now and take a closer look at Vedanta's financials. We've seen the headlines, record profits, impressive growth, but I'm eager to understand the details behind those big numbers. Where should we start? A good place to begin is with their revenue. In the second quarter of FY25, Vedanta's consolidated revenue reached 37,171 crore.
Right.
That's a 5% increase compared to the previous quarter. and a substantial 10% jump year over year.
A 10% year-over-year increase, that's pretty healthy growth. It seems like they're not just, benefiting from favorable commodity prices, they're actually expanding their market presence. What's the investor presentation say about the drivers behind this revenue boost?
They attribute it to a combination of factors, actually. Higher commodity prices definitely helped, as we discussed earlier, but they've also achieved higher sales volumes. And
Yeah.
here's the interesting part. They're commanding higher premiums on
Yeah.
their products.
So they're not just selling more, they're selling smarter. They're getting more value for what they produce. That suggests they're offering something, unique or valuable that the customers are willing to pay a premium for.
Okay, let's dive into EBITDA now. I recall you mentioned earlier that Vedanta achieved an EBITDA of uh, 10,364 crore in the second quarter, marking their second consecutive quarter above the 10,000 crore mark. And that's a 44% increase compared to the same quarter last year, right?
You got it.
And their EBITDA margin, which basically tells you how much profit they're making for every rupee of sales, reached an impressive 34%. That's a significant improvement of about 900 basis points year over year. Essentially, they're becoming more efficient at converting sales into profit. So it's like a double whammy, higher revenue and higher profitability. They're really hitting their stride. What's contributing to this increased profitability aside from, the favorable commodity prices we've already discussed?
Well, remember the strategic cost reduction initiatives and efficiency improvements we talked about earlier?
Yeah, yeah.
They're really starting to pay off. It's a testament to their focus on operational excellence.
So they're making their operations leaner and more efficient, squeezing more profit out of every rupee they earn. That's smart business. Now, before we get carried away by all the positive numbers, let's look at the cost side of the equation. First up, depreciation and amortization. Now, I know this might sound a bit technical, but it's an important expense to consider because it reflects the wear and tear on their assets over time.
Sure, the using up of their asset.
Yeah, exactly. So what was their depreciation and amortization expense in the second quarter?
It came in at 2,696 crore, a 2% increase year over year. This increase was primarily due to higher depreciation in their oil and gas segment and increased capitalization in their aluminum business.
So a slight increase, but nothing too alarming. It makes sense that their depreciation expense would go up as they invest in new assets and expand their operations. Now let's talk about finance costs. For those who might not be familiar with this term, it essentially represents the interest Vedanta pays on its debt.
Mhm.
How did that look in the second quarter?
Their finance costs totaled 2,667 crore, which is in line with our average borrowings. It was slightly higher than the previous quarter due to a one-time item in the first quarter.
Okay.
Year over year, finance costs increased by 6%, reflecting the increase in their average borrowings.
So their debt is costing them a bit more, but it seems manageable given their overall financial performance. Now let's switch gears and talk about something positive: investment income.
Okay.
Do they generate any income from their investments?
Yes, they do. In the second quarter, their investment income reached 722 crore. That's a 28% increase year over year, though slightly lower compared to the previous quarter due to a one-time gain they had in the first quarter.
Okay, so their investments are contributing positively to their bottom line. That's always a good sign. Okay, now let's get to the heart of the matter: profit after tax, or PT for short. What was their PT for the second quarter?
Before we jump to the final PA number, it's important to break it down.
Okay.
Their PT before exceptional items, meaning unusual or infrequent gains or losses, came in at 4,467 crore for the second quarter.
Sure.
That's a remarkable 230% increase year over year.
Wow, that's a massive jump in profitability. But you mentioned exceptional items.
Yeah.
What exactly were those, and how did they impact the final PT?
Sure. They had an exceptional gain of 1,136 crore. This was primarily due to an impairment reversal in their oil and gas business.
Okay.
In simpler terms, they had previously written off some assets in their oil and gas segment, and now they're reversing that write-off because those assets are considered more valuable today.
So it's like getting a refund on an old expense. Not a bad thing at all. But it sounds like there were some other exceptional items too.
Yes. This gain was partially offset by an impairment charge in their Avon Street business,
Hmm.
which focuses on advanced materials and technology and some additional tax liabilities related to their mining operations.
Okay, so some give and take with those exceptional items. What was the final impact on their PT?
After factoring everything in, Vedanta's final PT for the second quarter reached 5,603 crore. That's a 10% increase compared to the previous quarter.
All in all, it seems like a very positive quarter for Vedanta, but strong financial performance is just one piece of the puzzle.
Right.
What about their future prospects? Are they investing in growth? What do their capital expenditure plans look like?
They definitely are investing in growth, and they've outlined some ambitious plans in their investor presentation.
Okay.
They've already spent $109 million in the first half of the fiscal year on growth projects in their oil and gas business.
Oh.
This includes investments in infill wells, which are new wells drilled in existing oil fields to boost production, and an upcoming offshore drilling campaign.
So they're not just relying on their existing oil and gas reserves, they're actively exploring new sources to ensure long-term production. That's smart thinking, especially in a world that's, transitioning towards cleaner energy sources. What about their other segments? Are they making similar investments in growth?
Absolutely. They're investing heavily in expanding their aluminum operations, for example.
Oh.
They have projects like the Langigar refinery expansion and the Balco smelter and VAP capacity expansion in the works. These projects should significantly increase their aluminum production capacity.
That makes sense considering the growing demand for aluminum in various industries. It seems like they're strategically positioning themselves to capitalize on this demand. What about their other segments?
They're also investing in their zinc operations, particularly in mine expansions, to solidify their position as a leading zinc producer.
Okay.
And they haven't forgotten about their iron and steel operations either. They've allocated funds for expanding their ESL steel facility.
So they're investing across their portfolio to drive future growth. It seems like they're quite optimistic about their prospects. Now we've talked about their capital expenditure plans, but where's the money coming from?
They've been quite proactive in securing the funding they need. They recently raised a substantial amount of capital, a total of $1.4 billion, to be precise.
Whoa, that's a big chunk of change.
It is.
How did they raise that much money?
They use a combination of methods. They raised $1 billion through a qualified institutional placement, or QIP, which is basically a way to sell shares to institutional investors.
Okay.
And they raised another $400 million through an offer for sale, or OFS, of shares in Hindustan Zinc Limited.
So they're tapping into various funding sources to fuel their growth ambitions, but they also have, existing debt to manage.
Yeah, sure.
What does their debt maturity profile look like? When do their debts come due?
Good question. Vedanta has a diversified mix of funding sources for their long-term debt, which totals 69,500 crore, or about $8.3 billion.
A diversified funding mix is generally a good thing, right? It helps spread the risk. What about the maturity dates of their debts?
Right. Diversification is key. They have a good balance of rupee-denominated and foreign currency debt, which helps mitigate, currency risk. As for maturities, a significant portion of their debt is due in fiscal year 2025 and 2026, with smaller amounts maturing in later years.
So they have some significant debt maturities coming up in the next couple of years.
Yes.
Are they in a good position to handle those obligations?
They seem to be. Their strong financial performance, the recent capital they've raised, and their proactive approach to credit management all suggest they're well equipped to meet their debt obligations.
That's reassuring to hear. Now, I want to circle back to something you mentioned earlier, their demerger plans. It's a pretty big deal, splitting the company into 6 separate entities. Can you walk us through the rationale behind this move? Why are they doing it?
Sure. They believe that creating 6 distinct listed entities will unlock greater value for their shareholders. Each business will have more focused management and will be able to pursue its growth strategy more effectively.
So it's like they're creating more, nimble and independent businesses that can operate with greater autonomy and focus on their specific strengths. It's a bold move, that's for sure.
It is, and the process is well underway. Shareholder and creditor meetings are scheduled in the coming months. It'll be interesting to see how this restructuring unfolds and what impact it has on each of the newly listed entities.
Definitely something to keep an eye on. Now, before we move on to the final part of our deep dive,
Hmm.
I think it's important to understand how each of their, business segments is performing. It's
Yeah.
looking under the hood to see what's driving the engine of their overall success.
Great point. Let's start with their aluminum segment, one of their core businesses. In the second quarter, their aluminum segment delivered impressive results, generating revenue of 13,734 crore. That's a substantial 15% increase compared to the previous quarter and a 14% jump year over year.
Wow, those are some impressive numbers. What's fueling this growth in their aluminum business?
It's a combination of factors, really.
Okay.
They've achieved record production levels, as we discussed earlier, and they're reaping the benefits of higher aluminum prices.
Yeah.
Demand for aluminum is robust, both in India and globally,
Right.
so they're operating in a favorable market environment.
So they've got the wind at their backs, but they're also like making smart moves to maximize their advantage.
Exactly. They're not just riding the wave, they're paddling hard.
Yeah.
They're constantly looking for ways to reduce costs and improve efficiency in their aluminum operations. For example, their aluminum cost of production came down by 4% year over year.
That's a testament to their focus on operational excellence.
It is.
Lower production costs combined with higher aluminum prices create a perfect recipe for profit growth. Okay, let's move on to their Zinc India segment, another pillar of their business. Did they maintain their momentum there?
They did indeed. Zinc India delivered another set of robust results with revenue reaching 7,953 crore. That's a significant 21% increase compared to the previous quarter and a 16% jump year over year.
So consistent growth across their key business segments. It's becoming a recurring theme in our deep dive. What are the key factors driving their performance in Zinc India?
Just like with aluminum, it's a mix of favorable factors and proactive strategies. They've hit record production levels,
Yeah.
benefited from higher zinc and silver prices, and expanded their domestic market share. But here's something that might surprise you.
Oh,
Despite these positive tailwinds, they're not resting on their laurels. They're actively working to reduce their costs.
okay.
Their zinc cost of production, excluding royalty, came down by 6% year over year.
So they're not just riding the wave of higher prices, they're continuously optimizing their operations to become even more efficient. That's a sign of a well-managed company.
For sure.
Now, we've seen strong performance in their domestic zinc operations, but what about their international zinc business? How did Zinc International perform in the second quarter?
Well, Zinc International faced some headwinds in the second quarter. Their revenue actually declined by 6% compared to the previous quarter and by 19% year over year. It came in at 1,012 crore.
Oh, that's a bit of a contrast to the positive story we've been seeing so far. What happened? What factors led to this decline in Zinc International's revenue?
The primary culprit was lower zinc production at their international operations,
Okay.
specifically at their Gamsberg mine in South Africa.
Okay.
They encountered some operational challenges there, which impacted their output.
So some temporary setbacks at their Gamsberg mine are putting a dent in their international zinc operations. But despite this revenue decline, did they manage to stay profitable?
Yes, they did. In fact, their EBITDA for Zinc International actually increased by 31% compared to the previous quarter, reaching 378 crore. This improvement in profitability was primarily due to their cost reduction efforts, which helped to offset the impact of lower production.
So even in the face of adversity, they're demonstrating their ability to adapt and maintain profitability. It speaks volumes about their operational resilience. Now let's shift our focus to their oil and gas segment. How did that perform in the second quarter?
Well, their oil and gas segment encountered some headwinds as well.
Okay.
Their revenue declined quite sharply by 66% compared to the previous quarter and by 48% year over year. It came in at 2,825 crore.
Wow, that's a significant drop. What's driving this sharp decline in their oil and gas revenue?
A confluence of factors contributed to this decline. They experienced lower oil and gas production, coupled with lower oil prices compared to the previous year. On top of that, they faced higher operating expenses in their oil and gas segment.
So it's like a perfect storm of negative factors.
Right.
Lower production, lower prices, and higher costs. That's a tough situation to be in. Did this impact their profitability in the oil and gas segment?
Yes. Their EBITDA for oil and gas declined by 80% compared to the previous quarter and by 68% year over year. It reached 1,170 crore.
That's a substantial decline in profitability. Are they taking any steps to address these challenges in their oil and gas segment?
They are. They're investing in growth projects, as we discussed earlier, to increase their oil and gas production over the long term. This includes, those infill wells and the offshore drilling campaign we talked about. They're also laser focused on optimizing their operating costs and improving efficiency in their oil and gas operations.
So they're taking a multi-pronged approach, investing in new sources of production while also, tightening their belts and improving efficiency. It's a smart strategy, but it will likely take some time for these efforts to fully bear fruit. Now let's turn our attention to their iron ore and steel segment. How did that perform in the second quarter?
Their iron ore and steel segment also faced some headwinds. Revenue declined by 14% compared to the previous quarter and by 5% year over year, reaching 1,874 crore. And their EBITDA actually turned negative in the second quarter.
So another segment facing challenges. It seems like it's not all smooth sailing for Vedanta. What factors are contributing to this decline in iron ore and steel?
The primary factors are lower steel production and lower iron ore prices. They also faced higher costs in their steel operations. It's a similar situation to what we saw in their oil and gas segment, a combination of lower production, lower prices, and higher costs.
It's like a recurring theme, unfortunately.
It is.
Are they taking any steps to address these issues in their iron ore and steel segment?
Yes. They're actively working to improve operational efficiency and reduce costs in their steel operations. They're also focused on ramping up production at their newly commissioned Bikalim iron ore mine in Goa.
So they're working on both ends of the equation, optimizing their existing operations and boosting their production capacity. Hopefully these efforts will translate into improved performance in the future.
Exactly. Now, for the sake of completeness, let's briefly touch upon their fat core and copper segments.
Okay, what's the latest on those two segments?
Their fat core segment, which produces ferrochrome, actually performed quite well in the second quarter. Their revenue increased by 31% compared to the previous quarter, and by a whopping 93% year over year.
Wow.
It reached 272 crore. Their EBITDA also turned positive in the second quarter.
So a bright spot amid some challenging quarters for other segments. What's driving this positive performance in Facor?
It's a classic case of supply and demand.
Yeah.
They benefited from both higher ferrochrome production and favorable ferrochrome prices.
So things are looking up for their Facor business. What about copper? Are they seeing any signs of improvement there?
Unfortunately, their copper segment continues to face challenges.
Okay.
While their revenue increased by 38% compared to the previous quarter, reaching 6,376 crore, their EBITDA remains negative.
So despite the revenue increase, they're still struggling to turn a profit in their copper business.
Right.
What's the root cause of this ongoing challenge?
Their copper segment has been hampered by the ongoing shutdown of their Tuticorin smelter.
Right.
It's been halted since April 2018 due to various issues, and this has significantly reduced their copper production capacity.
So until
Yeah.
they resolve the issues with their Tuticorin smelter, it's unlikely we'll see a significant turnaround in their copper segment.
Yeah, this is probably a fair assessment. They're currently exploring legal options to restart the Tuticorin plant in a sustainable way.
Yeah.
But it's uncertain when or if that will happen.
Okay, so we've now taken a closer look at each of Vedanta segments. Yeah. It's a mixed bag. Some strong performers like aluminum, zinc India, and Facor.
Right.
But also some segments facing headwinds like oil and gas, iron ore, and steel, and copper. It's a good reminder that even successful companies face challenges.
Yeah.
And it's all about how they adapt and respond to those challenges.
Absolutely. Vedanta is a diversified company, and their overall performance is a tapestry woven from the performance of all their business segments. It's important to remember that even though some segments are facing headwinds, their strong performance in other areas is helping to offset those challenges and propel their overall growth.
Exactly. And their strategic investments, their relentless focus on cost optimization and their commitment to operational excellence are all positive signs that they're proactively addressing the challenges and positioning themselves for long-term success.
As we've been dissecting these results, it's become clear that Vedanta is walking a tightrope between maximizing their current profits,
Right.
and investing in a future
Yeah.
filled with uncertainties. We're talking about the energy transition, emerging technologies, evolving consumer demands. It's a lot to juggle.
Yeah.
What are your thoughts on how Vedanta is approaching this balancing act?
Well, what's fascinating to me is that Vedanta isn't shying away from this complexity. They're embracing it head on.
Yeah.
Think about their investments in renewable energy and their exploration of zinc-based batteries.
Yes, that's right.
These aren't just like side projects. They're strategic bets on where they see the world heading.
Exactly.
They're positioning themselves to be key players in the industries of tomorrow.
They are, and this forward-thinking approach is reflected in their financial actions too.
Right.
They're not hoarding cash.
Yeah.
They're strategically deploying it,
Yeah.
funding growth projects, managing their debt, and even returning value to their shareholders through dividends.
This raises an important question for us to consider.
Yeah.
How effectively are they balancing these competing priorities? On one hand, you have investors who are looking for immediate returns.
Right, the short-term folks.
Right. On the other hand, you have the long-term sustainability of the business, which might require sacrificing some short-term gains. It's a classic dilemma that many companies face.
Yeah, for sure.
It's the age-old tension between short-term profits and long-term vision.
Right.
But I think Vedanta's approach is quite nuanced.
Okay.
They're not just throwing money at every shiny new technology that comes along.
Right.
They're being selective,
Yeah.
focusing on areas where they believe they have a competitive advantage and can make a real impact. Their zinc-based battery venture is a prime example of this.
Yeah, it's a good example. And let's not forget their relentless focus on operational excellence, squeezing more efficiency out of their existing operations, frees up resources that they can then invest in these future-oriented projects. It's a smart strategy, allowing them to walk that tightrope more effectively. And their commitment to ESG initiatives is another crucial element of this balancing act.
Yeah.
It's not just about ticking boxes. It's about building a more resilient and sustainable business
Right.
that can weather the storms ahead.
It's like they're building a bridge to the future.
Yeah.
One strategic investment at a time,
Yeah.
while making sure the current structure remains solid.
Yeah.
But as with any bridge, there are risks involved.
Absolutely.
Commodity prices can be volatile, projects can face unexpected delays,
Yeah.
and those shiny new technologies might not always pan out as expected.
And those are all valid points. And we haven't even touched on the geopolitical risks that are lurking out there: trade tensions, resource nationalism, political instability in some of the regions where they operate.
Yeah.
These are factors that could significantly impact Vedanta's performance, no matter how well they manage their internal operations.
It's a good reminder that no business operates in a vacuum. The external environment can be unpredictable, and Vedanta will need to remain agile and adaptable to navigate these uncertainties. But here's what I find particularly intriguing. Despite all these challenges and uncertainties, Vedanta is pushing forward with their demerger plans.
Yeah.
It's a bold move, splitting the company into 6 distinct entities, each with its own set of opportunities and risks.
It is. It's a bold bet on the future, that's for sure. They're essentially saying we're confident that each of these businesses has the potential to thrive independently. It'll be fascinating to watch how this restructuring plays out in the coming years.
Mm-hmm.
Absolutely. The demerger adds another layer of complexity to the equation.
It does.
But it also has the potential to unlock significant value for their shareholders.
Yeah.
Like they're setting their businesses free to chart their own courses and capitalize on the opportunities that lie ahead.
And it'll be up to each of those newly formed entities to prove their worth,
Right.
to demonstrate their ability to adapt, innovate, and compete in a global landscape that's becoming increasingly dynamic and complex.
Well, I think we've covered just about everything there is to cover regarding Vedanta's Q2 results, from record earnings to ambitious growth plans, from
Right.
a commitment to sustainability to a major restructuring on the horizon.
Right.
This company is definitely one to watch.
And we've only scratched the surface.
Yeah.
Vedanta's foray into new technologies like zinc-based batteries is particularly intriguing. Could they become a key player in India's transition to a greener economy? That's something for you to ponder
Yeah.
as you continue to follow their journey.
That's a great point to leave our listeners with. Thanks for joining us on this deep dive.
Oh, absolutely.
Until next time, keep learning, keep exploring, and keep diving deep into the world of business and finance. So until they resolve the issues with their Tuticorn smelter, it's unlikely we'll see a significant turnaround in their copper segment.
Yeah, that's probably a fair assessment. They're currently exploring legal options to restart the Tuticorin plant in a sustainable way, but it's uncertain when or if that will happen.
Okay, so we've now taken a closer look at each of Vedanta's segments. It's a mixed bag, some strong performers like aluminum, zinc India, and Fakor,
Right.
but also some segments facing headwinds like oil and gas, iron ore and steel and copper.
Yeah.
It's a good reminder that even successful companies face challenges.
Yeah,
And it's all about how they adapt and respond to those challenges.
absolutely. Vedanta is a diversified company, and their overall performance is a tapestry woven from the performance of all their business segments. It's important to remember that even though some segments are facing headwinds, their strong performance in other areas is helping to offset those challenges and propel their overall growth.
Exactly. And their strategic investments, their relentless focus on cost optimization and the commitment to operational excellence are all positive signs that they're proactively addressing the challenges and positioning themselves for long-term success.
You know, as we've been dissecting these results, it's become clear that Vedanta is walking a tightrope between maximizing their current profits
Right.
and investing in a future filled with uncertainties,
Yeah.
where we're talking about the energy transition, emerging technologies, evolving consumer demands. It's a lot to juggle.
Yeah.
What are your thoughts on how Vedanta is approaching this balancing act?
Well, what's fascinating to me is that Vedanta isn't shying away from this complexity. They're embracing it head on.
Yeah.
Think about their investments in renewable energy and their exploration of zinc-based batteries.
Yeah, that's right.
These aren't just like side projects. They're strategic bets on where they see the world heading.
Exactly.
They're positioning themselves to be key players in the industries of tomorrow.
They are. And this forward-thinking approach is reflected in their financial actions too.
Right.
They're not hoarding cash. They're strategically deploying it, funding growth projects, managing their debt, and even returning value to their shareholders through dividends.
This raises an important question for us to consider.
Yeah.
How effectively are they balancing these competing priorities? On one hand, you have investors who are looking for immediate returns.
Right, the short-term focus.
Right. On the other hand, you have the long-term sustainability of the business, which might require sacrificing some short-term gains. It's a classic dilemma that many companies face.
Yeah.
It's the age-old tension between short-term profits and long-term vision.
Right.
But I think Vedanta's approach is quite nuanced. They're not just throwing money at every shiny new technology that comes along.
Right.
They're being selective,
Yeah.
focusing on areas where they believe they have a competitive advantage and can make a real impact. Their zinc-based battery venture is a prime example of this.
Yeah, it's a good example.
Yeah.
And let's not forget their relentless focus on operational excellence,
Yeah.
squeezing more efficiency out of their existing operations, frees up resources that they can then invest in these future-oriented projects.
Right.
It's a smart strategy, allowing them to walk that tightrope more effectively. And their commitment to ESG initiatives is another crucial element of this balancing act.
Yeah.
It's not just about ticking boxes. It's about building a more resilient and sustainable business that can weather the storms ahead.
It's like they're building a bridge to the future,
Right.
one strategic investment at a time while making sure the current structure remains solid. But as with any bridge, there are risks involved.
Absolutely.
Commodity prices can be volatile, projects can face unexpected delays, and those shiny new technologies might not always pan out as expected.
And those are all valid points. And we haven't even touched on the geopolitical risks that are lurking out there. Trade tensions, resource nationalism, political instability in some of the regions where they operate.
You're right.
These are factors that could significantly impact Vedanta's performance, no matter how well they manage their internal operations.
It's a good reminder that no business operates in a vacuum. The external environment can be unpredictable, and Vedanta will need to remain agile and adaptable to navigate these uncertainties. But here's what I find particularly intriguing. Despite all of these challenges and uncertainties, Vedanta is pushing forward with their demerger plans.
Yeah.
It's a bold move, splitting the company into 6 distinct entities, each with its own set of opportunities and risks.
It is. It's a bold bet on the future, that's for sure. They're essentially saying we're confident that each of these businesses has the potential to thrive independently. It'll be fascinating to watch how this restructuring plays out in the coming years.
Absolutely. The demerger adds another layer of complexity to the equation,
It does.
but it also has the potential to unlock significant value for their shareholders. It's like they're setting their businesses free to chart their own courses and capitalize on the opportunities that lie ahead.
And it'll be up to each of those newly formed entities to prove their worth, to demonstrate their ability to adapt, innovate, and compete in a global landscape that's becoming increasingly dynamic and complex.
Well, I think we've covered just about everything there is to cover regarding Vedanta's Q2 results. From record earnings to ambitious growth plans, from a commitment to sustainability to a major restructuring on the horizon, this company is definitely one to watch.
And we've only scratched the surface. Vedanta's foray into new technologies like zinc-based batteries is particularly intriguing. Could they become a key player in India's transition to a greener economy? That's something for you to ponder as you continue to follow their journey.
It's like a great point to leave our listeners with. Thanks for joining us on this deep dive.
Oh, absolutely.
Until next time, keep learning, keep exploring, and keep diving deep into the world of business and finance.